Most investors pick stocks the wrong way. They find a company they like, get excited, and buy it, without ever asking, is this actually the best company in its sector? Because here's the thing, if you're going to invest in cloud software, for example, there are dozens of options. How do you know you're picking the right one? How do you know you're not leaving a better opportunity on the table? Today I'm going to show you how to use AI to compare two companies in the same sector side by side, so you can make a smarter, more confident decision. This is how professional analysts narrow down their picks, and you can do it in under 10 minutes. Let's get into it. Welcome back to the AI Portfolio. I'm your host, a CFA charter holder with years of professional market experience. This channel gives everyday investors the same tools and thinking that used to be reserved for Wall Street. Free every week. Nothing here is financial advice. This is a research skill. Let's build it. All right, for this episode, we're going to use a real example. Microsoft versus Google. Both are mega cap tech companies with significant cloud businesses. If you had to pick one, how would you decide? We're going to let AI do the heavy lifting. Here's the workflow. Pull up ChatGPT or Claude. We're going to run two separate steps. Step 1 is data gathering. Step 2 is the comparison. Start with step 1. Paste this prompt in, write it down, or pause the video. I want to compare two companies as potential investments. For each company, please summarize 1. Trailing 12-month revenue and year-over-year growth rate. 2. Gross margin and whether it's expanding or contracting. 3. Operating margin. 4. Earnings per share growth over the past year. 5. Forward price to earnings ratio. 6. The primary business segment driving growth. 7. The biggest risk to the business right now. The two companies are Microsoft and Google. Use the most recent, publicly available data. Hit send. What you get back is a structured data snapshot on both companies, pulled from public filings, and analyst data. It's not perfect. AI can occasionally have slightly dated figures, but it gives you a fast directional comparison that would take hours to pull manually. Now, step 2. This is where it gets really useful. Take the output from step 1 and immediately follow up with this prompt. Based on the data above, which company looks more attractive as a long-term investment and why? Structure your answer as 1. The stronger grower. 2. The more profitable business. 3. The better value right now. 4. The lower risk option. 5. Your overall recommendation and the single most important reason. What comes back is a 5-point investment thesis. Comparison in plain English. Let me walk you through what each of those 5 points actually tells you. The stronger grower is the company expanding revenue faster. All else equal, faster growth commands a higher valuation. If one company is growing revenue at 15% and the other at 8%, that gap matters a lot over a 5 or 10-year holding period. The more profitable business is about margins. A company with higher gross and operating margins is keeping more of every dollar it earns. That margin advantage often compounds over time as the business scales. The better value looks at what you're paying for those earnings, the price to earnings ratio. A lower PE doesn't always mean better, but if two similar businesses are growing at the same rate and one is significantly cheaper, that's worth paying attention to. The lower risk option is the one with a more durable business model, less regulatory exposure, and stronger balance sheet. When markets sell off, lower risk companies tend to hold up better. And the overall recommendation is AI synthesizing all 4 dimensions into one clear bottom line. Now, one thing I want to be clear about, AI is a research tool, not an oracle. Use these outputs as a starting point, not a final answer. Cross-reference anything that surprises you. The goal is to get to a well-informed starting position faster, not to hand off your thinking entirely. Here's the full 2-step workflow so you can use it on any 2 companies you're researching. Step 1. Paste the data gathering prompt with your 2 companies. Let AI pull the key metrics for both. Step 2. Follow up with the comparison prompt. Ask AI to tell you which looks stronger on growth, profitability, value, and risk, and why. Step 3. Read the output critically. Look for anything that surprises you and investigate it further. Step 4. Decide which company, if either, deserves a spot on your watch list. That's it. 2 prompts, 10 minutes, and you just did the kind of side-by-side analysis that most retail investors never bother with. Your homework this week. Take 2 companies from your FinViz watch list, the one we built in episode 4, that are in the same sector. Run them through this 2-step comparison. Drop your findings in the comments. I want to know which one AI picked and whether you agreed. Next week, we're going deeper into valuation. I'm going to show you how to use AI to estimate what a stock is actually worth, so you can tell the difference between a good company and a good investment. Subscribe so you don't miss that, and I'll see you in the next one.